Welcome to The Explainer. Today, we're unpacking the Q2 2026 earnings report from Regions Financial. And honestly, this isn't just a dry spreadsheet review. It's actually a fascinating, real-time look at how a massive financial institution is navigating today's wild macroeconomic climate. We're going to break down their performance, their strategies, and what it all means for the broader economy.
So how exactly does a regional bank thrive right now? It's a provocative question, isn't it? I mean, we're living in a pretty complex environment. High interest rates, constantly shifting consumer behaviors, and a whole lot of market uncertainty. You'd think regional banks might be sweating a little. But as we're about to see, some are not just surviving, they are strategically adapting.
Before we get into the financial weeds, let's just establish the sheer scale we're talking about here. $549 million. That is Regions Financial's reported net income for the second quarter alone. It's a massive number that tells us right out of the gate, whatever they are doing, it is working on a very large scale.
To grade their performance, we're going to use a financial report card with 5 core subjects. We'll look at the top-line results, loans and deposit trends, income versus expenses, asset quality and risk, and finally, capital, liquidity, and dividends.
Okay, let's dive right into subject number 1, the top-line results. When you're evaluating a company, you really want to look at both columns here. The reported net income was that impressive $549 million, but notice the adjusted column. That strips out a one-time $40 million loss from repositioning securities. So in reality, their adjusted net income was $583 million. This adjusted view is absolutely crucial because it shows us the true fundamental earnings power of the bank for the quarter. You can see earnings per share and total revenue follow the exact same upward trend when adjusted, which shows an incredibly healthy core business. Beyond the raw numbers, their strategic wins are just as cool. Regions is consistently generating top quartile returns compared to its peers. But get this, their wealth management division, they just delivered another record quarter. Think about that for a second. They have broken their own revenue records in 5 of the last 6 quarters. Plus, they're actively expanding their capital markets capabilities, highlighted by picking up municipal finance experts the Fraser Lanier Company right at the start of Q3. Let's move to Section 2 and see how this builds. Loans and deposit trends. After all, a bank's whole foundation rests on where its money comes from and where it goes. Pointing out the juxtaposition here is just brilliant. On one hand, average business loans actually grew by a very solid 4% sequentially, hitting $66.6 billion, mostly driven by sectors like power, utilities, and manufacturing. But on the other hand, consumer loans dipped by 1%. This tells a fascinating story about the broader economy right now. Businesses are actively investing in borrowing to grow, while everyday consumers are kind of tightening their belts and paying down debt. We see that exact same consumer behavior reflected in their deposit trends, too. The bank saw modest overall deposit growth, but the underlying movement is what really matters. Customers are intentionally shifting their cash out of CDs and moving it into money market accounts. Why? Well, everyday folks are actively managing their money, reacting to current interest rates, and looking for flexibility without sacrificing yield. Honestly, you're probably doing something similar with your own savings. Despite all this shifting around, Regions managed to keep their non-interest-bearing deposit mix stable in the low 30% range, which is a massive advantage for keeping their own funding costs down. Now that we know where the money is coming from, let's flip over to Section 3, Income versus Expenses, to evaluate how well they handled that money. Real quick, before we look at the numbers, let's define a piece of financial jargon you'll hear all the time: net interest income, or NII. Simply put, it's just the difference between what a bank earns from lending money and what it pays out to hold your deposits. Think of it exactly like a retail store's markup on its inventory. It is the absolute core engine of a traditional bank's profitability. Now, what's really interesting about this performance engine is that net interest income actually increased by 2% quarter over quarter, hitting $1.29 billion. They did this primarily through that average loan growth we talked about, along with fixed-rate asset turnover. They managed to grow this total revenue pool even though their net interest margin, the actual percentage markup, dipped by just 1 tiny basis point. Making money is only half the battle, right? You also have to control what goes out the door. Regions reported an adjusted efficiency ratio of 56.9%. In banking, a lower efficiency ratio is better. It just means it costs you less to generate a dollar of revenue. By keeping their adjusted non-interest expenses tightly controlled at around $1.1 billion, they are generating enough cash to literally self-fund their own growth initiatives. No excessive borrowing required. All right, moving to Section 4, asset quality and risk. They're lending more and controlling expenses, but are they actually making safe bets? The single most critical metric for evaluating a bank's lending discipline is net charge-offs, or NCOs. This is basically the percentage of debt that the bank has given up on trying to collect. It's the money written off as a total loss. Take a look at the drop in their NCO ratio here. It tells an incredibly positive story. From the first quarter of 2026 to the second quarter, their annualized net charge-offs dropped by a significant 12 basis points. They went from 0.54% down to just 0.42%. Business criticized loans? Down. Total non-performing loans? Down. Across the board, their credit performance is actively improving, meaning the loans they've made are healthy and people are paying them back. And this brilliantly illustrates the core philosophy their management is pushing. By maintaining strict lending discipline, keeping a lid on expenses, and improving credit metrics, they aren't just chasing quick wins. They're building a foundation for generating consistent, sustainable, long-term performance, regardless of what the broader economy decides to do next. Finally, let's wrap up with Section 5, capital, liquidity, and dividends, to see what this financial discipline actually means for the shareholders. First off, safety. In the banking world, cash is king and capital is your fortress. Regions boasts a common equity Tier 1 capital ratio of 10.7%, which is way above regulatory requirements. But the real jaw-dropper here is their liquidity cushion. They have roughly $69 billion in total available liquidity. To put that into perspective, that is enough cash to cover 181% of all their uninsured deposits. That's the kind of massive safety net that helps depositors sleep very soundly at night. And because they are so well capitalized, they can easily afford to reward their investors. The board declared a quarterly dividend of 30 cents per share. That is a massive 13% increase over the previous quarter. For retail investors who prioritize income, this is a vital takeaway. Over the past 10 years, they've compounded their dividend growth at an impressive 16% annually. On top of paying out cash, they also spent $59 million buying back their own stock during the quarter. So the crucial point is this. When a management team raises the dividend by 13% and spends millions buying back their own shares, it is the ultimate signal of internal confidence. They are literally putting their money where their mouth is because they believe their stock is valuable and their future cash flows are rock solid. Which leaves us with this final question to chew on. With such an incredibly strong Q2 report card, improving credit quality, and that massive liquidity cushion, how will Regions Bank leverage this momentum for the rest of 2026? As interest rates shift and the economy continues to evolve, this is definitely a bank that has positioned itself not just to weather the storm, but to actively capitalize on it. Thank you so much for joining me for this explainer, and keep learning.